Yeah, good morning, everyone, and welcome to the August edition of the Black Star Market Color. As always, I'm your regular host. My name is Daniel Nilai Tete, and I'll be your moderator for today's edition. For those joining us for the first time, the Black Star Market Color is a virtual conference that comes off every third Tuesday of the month between 9 a.m. and 10 a.m. What we've been trying to do is to create a platform where people can share their opinions and receive insights and key happenings on the markets to enable them position themselves in the best way possible going forward. Today's edition, as advertised, will give us a review on Ghana's economy. I'm going to speak about FX and the media budget review, just like you asked for. Um, it's my singular honor to introduce our presenter for today. She's a very core member of our advisory team here at Blackstar, and her name is Rachel Kote, and she's going to be leading us for today's session. Rachel, can you hear me?
Yes, hi, Daniel, I can hear you.
That's awesome. Please go ahead.
Okay, Daniel, thank you very much for the introduction. I'm already excited to go into today's topic. But before that, I was just talking to a few people over the week, and I would just ask them how optimistic they were about the current economic outlook. And I'm guessing several people on the call have had that conversation where someone would ask, what's happening with inflation, what's happening with monetary policy and currency, and even looking at our debt levels as a nation, because everyone currently is just trying to understand where we are at. And you will find some people say that they are quite optimistic because the economy kind of like runs on a cycle where there are times you would see expansion, there are times where there are peaks, and other times there are troughs. So it's very, very possible that we could go back to those expansion levels. And you find others also saying that they are quite neutral, and others will also say, they are pessimistic because their favorite juice that they used to buy at 2 cities is currently now selling at 5 cities, and they don't think that that juice is going to go back to 2 cities. So this just to say that this is the reason why these presentations are done, just to give us all like a holistic view on the key happenings in the markets and the insights that we can draw from that. So, just speaking on happenings, there are currently two things that we have seen unfold in the markets from July to August that is quite interesting to talk about. And one of them is auctions. Recently, we have seen that the government auction has been undersubscribed for 5 weeks consecutively from the month of July to the month of August. And these uncovered actions that we have seen raise an interesting question of how it's going to affect the markets and government projects as a whole. Because looking at these 5 weeks, government has had a total of 33.94 billion in targets, but has just been able to raise about 29.48 billion in auction. And this is recording an under subscription of a 4.4 billion. So what is actually interesting about these shortfalls is that government has maturities that are coming up, especially the coupon payments. And we have about 6.1 billion for the whole of August that needs to be disbursed. And we have about 1.7 billion in pay in kind. And that is aside we mentioning the figure for T-bill maturities. So this is what we'll actually be looking at in the further slides. So from beginning from beginning of the year, we have seen T-bill rates been on a downward trend as rates were being reduced just to assist government manage its debt financing. But recently, we have seen these rates pick up again just to entice investors to come to the auction. We started the year with rates around 29% for 91 day, 31% for 182 day, and 32% for 364 day. But currently, we are seeing these yields at 24% for 91 day, 26% for 182 day, and 27% for 364. So the question here also is that how high are these rates going to go up that would cause investors to come into the auction at high volumes for government to be able to meet its targets. But that's the thing about market sentiments as well. Even though some investors are saying they would like to see higher rates to be able to come at high volumes, there are others who also see these high rates as signals for an upcoming default or the possibility of government defaulting on its maturity. So they will still want to see rates at level that governments will be able to cover. But when we look carefully at these auctions, we see that the targets have always been higher than what it is now. And this is what the chart is just trying to say. If we look at this line chart, we are just seeing this is a representation of the targets that government has set over the period. And the bar chart is just to show the various maturities across the 91-day bill, the 182 and the 364. So from here, we see that the targets have always been higher than what government is raising on the market. And if we should compare this to the year before, during that time, that's 2023, we will see that there were targets of about 135 billion. But however, in 2024, we have seen targets increase to about 157 billion. And if we should look at these targets against maturities, we see that even though the target figure of 157 billion is there, we see that the amount maturing is about 115.7 billion year to date, which is about a 26.25% difference. So this could be even an answer to our initial questions to say that even though from here we are seeing that government is undersubscribing or missing its targets, even though government is missing its targets, it's because there are higher targets that it has said that the liquidity in the markets might not be able to cover. So with this huge targets, even if investors should roll over all their maturities, governments might still not be able to meet these targets. And also, this is the year that we have seen government goes to IMF. We've seen governments restructure its debts, and this has sucked up more liquidity from the markets. So we are seeing this as a reflection of investor appetite when it comes to government securities. Another sentiment in the markets is also the increase in the CRR, because in March we saw that government sent a new CRR, the BOG sent a new CRR directive, which stated that banks with loan to deposits ratio of about 55% would have to meet a CRR of 15%, and banks with loan to deposits ratio of about 40% to 55% will have to meet a CRR of 20%. And we know that the higher the CRR is, that's the lower the liquidity we would have with banks and vice versa. So with the defaults that have happened last year, we have seen currency depreciation, we have seen high inflation environments, we have seen investors moving away from government securities, and this is all feeding into the decline in auctions. And not just that, but we have seen high volumes in BOG auctions as well. And over the past month, BOG has raised over 22.2 billion, which is an 88% increase from the previous month. So even people are moving away from these T-bills that we are seeing, they are moving towards the BOG because it's offering them higher rates, which is around 29%. So this is just to state that these are the reasons why we are seeing the dip in volumes when it comes to the T-bill auctions. And with the low liquidity that is coming from banks and the markets, and the government not being able to meet their targets is something that we have to pay attention to. And it's really important that we look at what's really happening, the trend that has occurred over time, and what that would mean for our fund managers and for investors like ourselves also. So now let's even look at the new money charts. This is just to show the difference between the amounts maturing versus the amounts that has been accepted. And this is the government has raised about 22.8 billion in new money since the beginning of the year, which may probably be a buffer for the shortfalls that we saw initially from the previous slides. But the question is, would this be able to cover all the upcoming maturities and governmental projects that are in place? So from here, we see that this was when the new CRR was introduced, and we saw some shortfalls over here, and we saw that new money picked up consecutively for about 2 weeks, and then it fell off, and we've seen the pickups, and now we are seeing the fall again. So this just say if this gap this gap should just persist, we may find ourselves at a point where governments might need to strategize on how it's going to get its auctions and volumes up. And this is where we are going to see, there's a possibility that we might see that rates are going to increase just to entice investors to come to auctions. But this is also something that is quite that we also have to look at, because it feeds into inflation when there are high interest rates, and that could mean higher levels of interest payments, with maturities also being heavier. And on the secondary trading activities, we have seen volumes that have been on a decline from this period until this period, but we have seen it start to pick up at the end of July, and this could also be an indication of some level of confidence on that side. So from here, we can see that the average trading volume was recorded to be about 10.3 billion, and the trading volume that was recorded in July was about 13.87 billion. So this, I mentioned that there are two happenings that we have been looking at, and the first is the auctions, but the second that it's quite important to also look at is the mid-year budget review, because everyone has been anticipating the budget release since this is an election year, and we are looking forward to what governments may do or may not do, and how this decision is actually going to affect real money in the economy. So we are looking at things from the slides coming up. We are just going to look at things from the numerical viewpoint and key indicators, just to see how the nation has fared with its various policies that has been put in place, and going forward, what those policies are going to do, and how it's going to shape our markets. So this is just to give a broad view of the flagship programs that have been introduced since 2017, and how that has affected the resulting trend in fiscal deficits, government savings, and the levels of composition when it comes to government revenue and expenditure. So from here, we see that in 2017, this budget was teamed as a sowing the seeds for growth and jobs. But Ghana's overall economic strategy over the age has been one of a financial and restructuring adjustment, and it's just been an integral part of what government has set to do, just to make sure that we become a middle income country. So in 2018, we decided to expand the initiatives, which was started in 2017, where we started the free secondary education, the one district, one factory, and the one village, one dam. So we think that as putting Ghana back to work, where we focused on investing in infrastructure, industrialization, agriculture, and agribusiness, and from that point, we saw a growth in the economy with an overall GDP of about 5.4%. And in 2019, that is when we introduced the National Identification System, and we went on to introduce the Ghana Cares and Agenda 111. That was just to cater for what happened when it came to the COVID period in 2020. And we saw that in 2022, there was a social intervention where we were pumping money into housing, training, and retraining of employees in the country. But this is just to give an overall picture of the policies that government puts in place, just to see that the economy is going from one point to the other, because when it comes to what makes an economy what it is, it comes to it goes all the way to productivity, what we are doing to make sure that there's productivity in the nation. But we are just going to see that with these policies that government has put in place, it cannot be established without revenue or expenditure. So in the next slide, we're just going to see what happens when it comes to how government gets its revenue and how it's spent on these projects. But before that, we are going to look at the budgets that was released this year. That was the review budget. And we saw that government put in place new policies just to make sure that there's sectoral growth. So on the agriculture side, we saw that there was an increase in supply of premix for all. That was for the enhancements in aquaculture production. And on the industry side, we saw that government has put in place 13 vehicle assembly plants, which is to be established just to focus on the local electric vehicles, and it's penetrating into the established now markets. On the tourism side, which is quite interesting, we saw that there was a redevelopment of sites, such as the Ebri Gardens and the Precoro slave camp. And just to run through the technology side, we are still focusing on, we were making up policies focused on the Ghana Cares program, which is the digital youth skills hub, which is to be established to enhance digital skills among the youth. And on housing, we saw that there were over 1,000 kilometers of drains which were constructed and rechanneled just to mitigate the impacts of floods. And lastly, on the finance, there was a 5.9 billion which was paid in coupons for February, and an additional 6.1 billion which is to be paid in August 2024. But what is new in the budget is the reintroduction of road and bridge tolls in 2025, and the disbursement of 1.5 billion to provide relief and bailouts for the locked up funds and fund management firms. And on the taxation side, we see that there's the operationalization of the integrated property tax system. And lastly, the strategy that we want to embark on is the establishment of independent fiscal council. So aside these policies that government has revised, it has the 2024 initial targets that it has set. There were also some changes on that side. Initially, we set a target of 2.8% when it came to overall real GDP growth, but we have revised it to 3.1% for the rest of the year. And on the non-oil real GDP side, which was set to be a 2.1%, has been revised to a 2.8%. And for inflation, which we set in December 2024, 15%, still remains that same 50%. But on the imports cover side, which was 1.7, we have changed it to 3.0. And GDP as primary balance on commitment basis of 0.5% still remains that 0.5%. So just looking at our revenue and expenditure, this just shows the level at which our revenue is able to cover the expenditure that we have year on year. So this is just showing from 2008 till now, how much has our revenue been able to cover that expenditure. So over the years, we have seen growth in our revenue levels, but it's just able to cover just the part. And this just to highlight that in every election year, what really happens when it comes to our revenue and expenditure. So from 2008, which was an election year, we see that our revenue was able to cover expenditure of just about 70.2%. And over here, it was a 96.1%, which is quite interesting. But on this period, we saw that it was able to cover just a 57.2%. And this is where we are at now, just for the first half of 2024. We see that we have actually covered 73.8% when it comes to how much our revenue is covering as our expenditure. But that's because there has been a general increase in revenue generation from 2017 till now. And from here, this is just to show the revenue figures that we have over the years, and we see that Now, if we look at the components of government revenue, we have line items like the tax revenue, that is taxes on income, property, taxes on domestic goods and services, and even international trade taxes. We also have the social contributions, that is the SNIS contributions, and we have non-tax revenue, and we also have grants. So there are various ways that government is able to generate revenue, and we have seen growth in that. In 2018, we saw that the highest taxes that government was able to raise was on the income and property, which was about 40%. And we have seen that in 2019, there was an introduction of the GET Fund, which increased revenue by about 47%. And over the years, we've seen even in 2023, when the whole IMF period came, we have seen various taxes that has been introduced, such as the COVID-19 health levy tax. We have seen taxes that have been other taxes as the COVID, I've mentioned the COVID-19, but we've seen NHIL taxes also increase over the year. So generally, just to show that even though our revenue has been increasing, our expenditure has also been increasing far more than the revenue. So this is just to show that shortfall between the revenue and expenditure. And from here, we see that the largest budget deficit that government has had was in 2022. That was since 2018, 2008 has been in 2022. And we have seen that there have been consecutive shortfalls from 2020 till now. And even though expenditure enables the economy to grow, it actually becomes something that is concerning when these shortfalls are growing faster than how much the economy is growing. And this currently 2024, we have seen the shortfall of 27 billion, but this is just to show a projection that we have just 4 more months to go into the year, and it's also an election year. So each election year, we see that expenditure kind of like increases because of the whole election. So if we should project till the end of the year, there's a possibility that we might see that large deficits that we incurred in 2008 happen right now. And I mean, people might look at this chart and say that government, even though government needs to check these fiscal deficits, they can't say that they are going to stop spending, because increased government spending can actually stimulate economic growth, especially when it's directed towards investment in infrastructure and education, which can actually lead to job creation and increased demand for goods and services. But there's also the other side that we have to look at, is that these deficits also feed into our inflation figures. It feeds into our currency depreciation. So even though it's leading to economic growth, it's also something that needs to be managed. So the moment that we have these shortfalls, the question is that how is government able to cover these shortfalls? And that has led us to look at the debt profile. So this just say that what does our debt profile look like? And if from here we see that government usually borrows from the markets in terms of bonds, in terms of bonds, in terms of bills, in terms of cocoa, in terms of pension funds, local dollar bonds, and then the euro bonds. So this figure of this 2024 figure of 125.9 billion is showing from now till the end of the year how much government has to cover in terms of its interest payments, and that is quite a high figure if we look at the current revenue that we have and how much expenditure we've already incurred, and we have all of these payments to be made. So it's quite interesting to see that. And the more government is borrowing, and the more we are seeing this overspending behavior, we see that debt levels are increasing, and it's just crowding out these private investments. And we are seeing this high inflation and this high exchange rates. And I've mentioned inflation and currency in the previous slides, but it's just interesting for us to look at. So if we look at this inflation charts, we have seen that there has been a sharp increase in our inflation figures that we have seen that early last year or late last year in November, we saw that our inflation was around 54.1%, but we have seen this inflation figure come down a bit. In previous months, we saw inflation around 23%. That was in like around February, but now currently we are seeing inflation at 20.9%. And this is actually a good thing to see, because if there's more money creation from the interest payments that we are making, it's good to see that the effects of inflation that we're probably experiencing earlier is kind of like easing down a bit. But this is just for us to learn that usually a high interest rate environment usually faces inflation. So if we look at this period of high interest rate high inflation rates, we see that it was mostly the same period in which we were seeing government expenditure increase by high margins. And on the monetary policy side, usually in order to control price stability, we have seen monetary policy rate change over time. There was a hawkish trend initially, where in 2022, monetary rates were hiked by about 1,250 basis points. But currently, we are seeing a cut in monetary policy rates about 100 basis points. So the slowdown of inflation that we saw earlier is what has opened the way for these rate cuts. And these rate cuts are actually good for us, because they are set to reduce the cost of borrowings for businesses, just to encourage spending and investments, which can actually stimulate economic growth. But these rate cuts actually needs to be done gradually, as lower rates can also increase the demand of currency in the economy, potentially leading to higher inflation. That's if our supply cannot keep up with the increased demand. So it's also interesting to see that we are starting to cut rates, but it's, even though it's improving macros, it's softening inflation, and the sluggish private sector growth is still a figure that we still have to be looking at closely. And on the currency side, we've seen how there has been persistent fiscal deficits, and this has led to increased borrowing and higher debt levels, as mentioned earlier. And this is where it has brought us when it comes to currency, because investors believe that the moment the government is struggling to manage its debts, or if its deficits are being financed through money creation, that is the printing of more money, it can lead to lower confidence in the markets. That's how come we are seeing the depreciation of the currency. But this is because the high deficits usually signals economic instability or a potential increase in inflation. So it kind of like reduces the currency's attractiveness to investors. So we see that even when it comes to our foreign investors, we just saw that there was a decrease in that, because people just see the economy as unstable, so they really don't invest much. But higher interest rates can actually also attract foreign capital. We mentioned that earlier, that there's a possibility that we might see higher interest rates, and this can also support the currency in the short term. But as said, it's also something that has to be done and managed well. Otherwise, we might see the opposite effects that we initially put in place to have. And this is just to say that on the GDP growth side, we have also seen sort of like improvements in terms of the targets that government set and the actuals that they were able to meet. So in 2021, we saw that government had a target of 5.1, but then GDP growth was about a 5.4 in 2022. And they also exceeded their targets, because they had a target of 3.7, but the actual was at 3.8. And in 2023, they had a target of a 1.5, but then GDP growth was about a 2.9. So we are seeing an overall improvement when it comes to our GDP growth. But then what is interesting to also see that even though it's an improvement, that is because the targets that we have set has actually been decreasing from this period until now. So that could mean that because of the current economic condition that we are facing in terms of we going to IMF and restructuring our debt, it reduces the GDP growth targets that IMF usually sets for us. So we have seen a reduction in that, but still we are seeing that we are exceeding our targets, which is quite good. But on the Eurobond side, 2 months ago, Ghana and its Eurobond investors actually reached an agreement in principle to restructure about 13 billion of USD of their bonds. And it was said that Ghana bondholders were to forgo about 4.7 billion of their claims, and that's almost 40% of face value of these bonds. But this is also an important step for us in terms of we trying to figure out and resolve many of our debt issues. And actually, these were all parts of the directives to unlock the IMF deal. So from there, we have seen that the performance of Eurobonds have actually picked up. And from here, we see that Ghana Eurobond is about 57.75% in performance. And in USD term, it's about 19.71%. But domestically, domestic bonds is about 0.47%. So with all these agreements to restructure the Eurobonds and make sure that we are meeting the set targets that we have, the performance has actually been, has actually improved, which is also interesting to look at. And on the equity side, the Ghana Stock Exchange has actually shown a remarkable year-to-date performance, which is actually driven largely by non-financial stocks. So from here, we see that Unilever is standing out as the top performer, which is surging about 97.29%, which is closely followed by GCB with a 73.53% increase. And this strong performance has actually pushed non-financial stocks to actually grow by an impressive rate of 62.09%, which is far outpacing the financial stocks, which is currently at an 11.19%. So on the non-financial stock side, we are seeing that growth has actually stalled a bit. The financial stock side, but on the non-financial stocks, we are seeing that it has been some form of improvement. And if we look at EGL and CalBank, they have faced substantial declines of about 30.96% for EGL and 29.17% for Cal. But notably, Atlantic Lithium that listed last year is up by 33.36% year to date. So this is on the equity side. And if we look at our commodities, the commodity market is actually known for its volatility. So we see the upward and downward trend when it comes to commodity prices. But it's usually factored by items such as our supply and demand dynamics and geopolitical risk. So the commodity market this year has actually experienced significant shifts in its year-to-date performance, with the cocoa standing out as the dominant performer. And we see that cocoa has recorded an 117.7% performance year to date, which is outperforming gold and oil. And if we look at it broadly, but gold has also performed quite well with a performance of 20.29% year to date, which is also driven by the large surge in demand from China. And in contrast, we are also seeing that oil has shown a modest growth of 2.58% year to date, with initial rallies dampened by the easing geopolitical tensions between Israel and Iran. So this is just to give us a general view on what is really happening in the markets in terms of our FX, in terms of our inflation, monetary policy rates, and also in terms of the budget release and the policies that we have set to put in place. But this is just that we have made headway. We have looked at how GDP growth has increased by government exceeding its targets. We have also seen a downward trend when it comes to inflation, and we have seen monetary rates also being cut. But this is just not to say that we should jump around, but then this is just to say that even though we have seen improvements in various sides, what we have to also pay attention to is our expenditure levels, because even though revenue is increasing, our expenditure is increasing by far more. And also, if we look at our current auctions, which is an important source of revenue for also the government, and the government is also missing their auctions when it comes to that. It's also something that we should look at. So in the long run, we are on a good road, because we have successfully concluded the second review of our extended credit facility, which was mentioned in the budget release. So we have seen a third tranche of disbursements of 360 million, which is bringing a total disbursement of about 1.6 billion USD when it comes to our IMF program. We have also completed the debt restructuring program, which is with the official creditor committee, which covers about 5.1 billion USD. So summing that together is about 2.8 billion USD of debt relief. So these figures are actually good to look at. And even on our Eurobond side, as I mentioned, we have had sort of an agreement on that side, which is also going to feed into the management of our debt levels. So that is where we are at as a nation. But as I mentioned again, we have to just look at our expenditure levels, and then we will see improvements, and hopefully we can move away from this place of uncertainty and move into a place of stability and expansion in the economy. So this brings me to the end of my presentation.
Very much, Chukwuti, for that presentation. Thank you very much. I had a lot to write down. I'm sure others did as well. It's the past we would issues. And then Rachel and the team will take your answers on. So to us, if I can be here, is my voice audible? You know. Yeah, I can be heard now, right? Awesome, that's cool. So I was just inviting everyone to bring in their questions if they have any, so that we can address them and then have a meaningful discussion on where this country is going. But my first question to Rachel, this question is to you. It's a very subtle one. The question is, do you think as a country we are living within our means, and what you have to say on that bit? So Rachel, this one is to you.
Yes, no, and thank you for the question. So, looking at the charts, we looked at the current revenue and expenditure levels of the government, and we are seeing that expenditure is just way above its revenue. I mean, there are some governments that manage a fiscal deficit economy just because they want to pump money into the economy just to bring about growth. But when these expenditure levels are way above revenue and we are seeing that we are in a place of restructuring our debts, that is when it becomes interesting and it becomes something that we have to pay attention to. But on a general level, from this chart, we can just see that we are actually not meeting our expenditure. So that is just something we have to look at.
Yeah, thank you very much, Rachel, for that answer. I heard you mention quite a lot of solutions that you felt that as a country we should try undertaking to ensure that we return this country to where it's actually supposed to be. My only question is, do you think some of the plans that we have set out to do, how feasible do you think those solutions are to where we are up, like just off the top of your head?
Okay, thank you, Daniel, for the question. I believe that the plans that we have put in place in terms of even them looking at the mid-year budget review is something that is important and is something that is quite feasible because the government is actually moving in this way to make sure that we are seeing developmental projects happening in the country. So currently, even when we look at the road sector, they have actually invested almost about 10 billion since Jan 2024, which is set to enhance transportation and also spare growth. And this is in their commitment to infrastructure development. And they've actually made progress on the projects that they stated in the budget. So if we look through very well, we realize that most of the plans that government puts in place are something that they actually establish and something that they make sure it happens. So even on the broad view, looking at the overall summary of the policies that they've put in place, there were years where they would just state in the budgets that they are just going to continue projects that they started in previous years, just to make sure that there's always innovation when it comes to that. And even on the national identification system that they mentioned, they invested about 135 million in that, and we have seen that government has actually done a lot to make sure that we are growing as a nation. But in that comes, it doesn't just end there, but then there's also control and management of these policies and projects that are set in place.
Thank you very much, Rachel, for your submission. The floor is still open for contributions. And just on recency bias, we saw a chart where we saw governments and the under subscription of its at its auctions, and I was looking forward to hear a discussion on what the market thinks and etc. So the floor is still open for those who have questions, and we'll give it about 3 minutes. If we don't get questions, we'll go right into our polls for today. So I'll open the floor for just about 5 minutes to get questions. You can type them in the chat box. You can raise up your hand, and we'll give you the opportunity to speak. Yeah, so while we wait for questions to come in, I'm going to launch the polls. So our first question, just poll. So our first question for today is, after July's inflation rate declined to 20.9%, what is your estimate for inflation in August? What's your estimation for inflation in August? Is it going to fall below 21%? Is it going to be between 21% and 21.9%, as in going up? Do you think it's going to go up to around 22% to 23.9%? Do you expect it to go between 24% and 24.9%? And do you expect it to be above 25%. These polls are very much anonymous, and usually after we're done with the call, we share with the market. Every single person who voted or participated in the polls is able to see what the general market also has or thinks about. So do well to engage in the polls, and let's have a discussion after. And mind you, government sets for itself a target of around 15% to end the year. So it depends on where your view is on where you think inflation is going to end by the end of the year as well. So to our next poll, what is your forecast for inflation by the end of this year? Do you expect it to fall below 13%? Do you expect it to be between 13% and 14%? Do you expect it to be between 14% and 15%? Do you expect it to be between 15 and 16, or just be above 16%, missing the target that the government sets for itself? I can see so far about 72% think that we are going to finish above 16%, which means that we expect inflation to miss a government's target of around 15%. We have about 16% of respondents saying that inflation is going to be around 15% and 16% by the end of the year, and about 11% saying that it's going to be around 14 to 15% by the end of the year. Our next poll, which I'm going to launch right now, is what's your forecast for the exchange rate, given that the cedi is 23%, given the 23% drop that we've seen in currency as of now? Do you expect currency to be stable with positive factors in play? Do you expect it to be volatile and driven by global economic factors? Do you expect it to depreciate due to internal economic challenges that we have currently? Do you expect it to appreciate due to increased investor confidence on the markets? What do you think? Yes, so far about 58% think that our currency is still going to depreciate due to some of the internal challenges that we have in our economy. About 33% think that the currency is going to remain volatile, driven by global economic factors, and about 13% say that it's going to be stable and with positive factors in play. Now just right onto our next poll. And how confident are you that the budget will achieve its intended economic outcomes? And we've seen several budgets over the years aiming to address certain pertinent issues that we have in our economy, but we've had very rough patches throughout that period. We've been in very dire situations at some points. Do you think that this budget how confident are you that this budget will achieve its intended economic outcomes by the end of the year? Yeah, there you have it. About 38% say that they are not confident at all that the media budgets will be able to meet the intended economic outcomes. We have about 31% saying that they are not very confident. You have about 31% saying that they are neutral. And there's no one saying that they are very confident or they are somewhat confident. Most of our respondents are around neutral, not very confident, and not confident at all. Please keep voting or responding to this poll. Our next poll which I'm going to launch right now. Which of the following do you believe will be the biggest challenge in implementing the current budgets? Our first multiple choice answers are revenue shortfalls, which Rachel has very much spoken about, and then public opposition. And we've seen a lot of taxes also try to be reintroduced. We've seen the road toll being reintroduced, etc. And the next one is fiscal instability. We've seen debt numbers. We saw that very scary maturity profile. And do you think it's going to be global economic conditions that's going to prevent us from being able to achieve the budgets that we've set before ourselves? So about 87% so far think that fiscal instability is going to be one of the main headaches that we are going to have in trying to implement in this current budgets that we have. About 13% think that it's our revenue shortfalls that's going to shoot us in the foot. Please keep responding to this poll as well. Our next question, do you think the current budget addresses the needs of the most vulnerable in our population? Do you think that it's in any way addresses the needs of what the most vulnerable in our economy or in our population really need at this point? And you can say that you strongly agree, you can say that you agree, you are neutral, you disagree, you strongly disagree. And about 58% say that they disagree that the current budget addresses the needs of the most vulnerable in our population. About 36% say that they strongly disagree as well, and about 12% say that they are neutral about their position. Is the votes, the polls are still open. You can go back to any of the ones that we've already posted and try and vote as well if you want to have records of the polls that we just run for your research reports, etc. Our next poll is, we have about just 8 polls. This is the last but one poll. What is your view on the current fiscal deficits? Do you think that it's a major concern that needs to be immediately addressed? Do you think it needs immediate attention? Do you think that it's concerning but it's manageable? Do you think that it's neutral, not too high or it's not too low? Do you think that it's low and it's under control? Are you not sure? What's your position on our current fiscal deficits as a country? And so far, we have 10 respondents and about 100%. Okay, that drops to 77. 77% think that it's a major concern that needs to be immediately addressed. It needs immediate attention. We have about 23% saying that it's concerning, but it's manageable. That's very interesting. Just now, we have about 6% saying that it's not too high or it's not too low. That's interesting to know as well. And for our very final poll, we have, which sector do you believe should receive more budget allocation in the next fiscal year? Do you think that healthcare is something that we should really look at as a country? Do you think that's education? Do you think that's infrastructure? Do you think that's defense? Do you think that's social welfare? What do you think? Where do you think government should be putting its money or allocating resources in the next fiscal year? So far, we have about 70% saying that they believe government should allocate more to infrastructure. Interesting. We have about 27% saying that it should go into healthcare, about 13% saying that it should go into social welfare. We have about 11% saying that it should go into education. So a chunk of the people that have responded so far, sorry, believe that government allocation should go into infrastructure. That is very interesting to know. Do we have any questions so far in the chat box? Yeah, I think even though there are no questions, I believe that there's a question in the chat box. Yeah, so we have a question from Evans Apia. Thank you very much for your question. Your question says that how are the banks reacting to the new CRR policy, and is there any effect on the undersubscription on the T-bill markets or the T-bill auctions? Rachel, I think you can answer this one.
Okay, thank you very much for your question. In terms of how the banks are reacting to the new CRR directive, as I mentioned earlier, this kind of like sucks up liquidity that the banks usually have. So the amounts that we would see being accepted at auction past the CRR directive, we wouldn't see that levels anymore because there would be a decrease in terms of the fact that there's a new CRR directive which is actually higher than the previous one. So that is how come we are seeing some of the shortfalls that we have seen consecutively for 5 weeks now. It's also part of the reasons because banks, the liquidity that banks usually have that they would use to come in at auction, they are actually using it to meet their CRR. So that is the effects that we are seeing right now.
Yeah, thank you very much, Rachel. Evans, is that fine, or you have a follow-up, or does that make sense? You can give me a thumbs up, or you can just type in the chat box. Okay, that's fine. It seems we don't have any other question. Do we have any contribution? If there are no questions, anything that anybody would like to add on to the session that we've had so far? I'll just open it up for about 2 minutes, and we are 3 minutes beyond our time for today. I'll just give it 2 minutes for any contributions, if anyone has any, and then we'll draw the curtains on today's session. You can just raise your hand and then I'll unmute you, and then you make your submission, and then we call it a day. Okay, thank you very much for joining us today. And thank you very much for the questions that came. Thank you very much for participating in the polls that we went through today. Rachel, thank you very much for your presentation today. You've given us enough food for thought for the rest of the weekend, hopefully for the rest of the year. Thank you guys for being a part of this session. And before I forget, ACI is having a program. They are organizing a financial markets conference on the 22nd of August. That's just a start day, and then an Olympic sporting events on the 24th as well. Blackstar will be there, so make sure that you are there. On the other hand, Blackstar remains your one-stop shop. We manage 6 of the top performing funds in Ghana: FIAP, EBF, PBF, BIF, and just recently the Delta Fund. Our brokerage desk has access to multiple exchanges across the world, and we can assist you with all your needs as well. Our investment banking team, as always, is ready to help you outdoor yourself to the market, help you raise funds, capital on the market to expand your business. Our advisory team are always available to help you in all of your needs. And our research team as well, always available to share meaningful insights with you to help you position your fund and make good investments, create wealth for yourself. For more insights, you can follow us on social media pages. You can follow us on Facebook, Instagram. You can follow us on LinkedIn as well. We share a lot of insightful stuff there. You can follow us also on YouTube. We just launched our YouTube page. You can follow us on X as well. We post some interesting stuff there as well. So just connect with us. Very recently, we launched our WhatsApp channel as well. You can join us on that platform. We share quite some insightful stuff concerning the markets and where the market is going. And thank you very much for joining us, and see you in the next Tuesday of September. Have a nice day.